If you think approved means the store got paid, you are missing the real transaction. At the counter, it feels finished. Behind the counter, the payment is still moving. Take a $5 coffee. You tap, the terminal approves, and you walk away with the drink. From your side, the story looks finished. Tap, approved, receipt done. For the business, that same tap starts messages, risk checks, records, fees, and payout timing. The whole chain becomes easier once you separate 3 jobs: authorization, clearing, and settlement. Authorization is the fast yes. Clearing is the record work. Settlement is when money moves between institutions. By the end, approved, pending, and paid will feel like 3 different moments, not one confusing word. Before money can reach the store, your tap has to pass through a small chain of companies and banks. You just see a tap and an approval. In the payment chain, you are the cardholder. The merchant is the cafe, store, or website that wants to get paid for the sale. A processor is like the store's payment messenger. It helps send the request into the card system. The merchant's payment provider or acquiring bank is the business side connection to that system. The card network sets the route and rules so the merchant side can talk to your bank side. Your card bank, the issuer, gives the yes or no for your account. The first step is authorization. It is not payment, it is a permission check. The merchant system sends a question through the network. Can this card be used here for this amount? That question includes the card, the merchant, and the amount. It is asking for a yes or no. Your bank checks whether the account is active, the card looks valid, and enough available credit exists. The system may also evaluate risk signals, because a card can have credit available and still look suspicious. If the bank says yes, an approval message travels back to the merchant. That is why the terminal can say approved in seconds, but seconds do not mean the store has been paid. In many cases, that yes creates a temporary hold. Your available credit can drop before the final charge is complete. That is why your banking app may show pending. Pending is a clue that the story is still open. You notice this with hotels, gas stations, restaurants, or rental cars, where the final amount can change. If the authorization is not needed anymore, it may be reversed and the hold can be released. That is different from a refund. A refund is what happens after a transaction has already settled. So approved usually means authorized. It does not mean every record is finished or every dollar has landed. After authorization, clearing turns the approval into usable records. The system lines up the amount, merchant, date, card details, and transaction IDs so every side is talking about the same sale. Many approved sales can move together, instead of every coffee becoming a separate cash movement. At the end of the day, a merchant may close a batch, so approved transactions can move forward. Clearing helps the cardholder side and merchant side agree on what should be posted. Approval alone says yes. Clearing makes the sale countable, matchable, and ready for money movement. Settlement is where the money side starts catching up with the approval message. Instead of moving cash for every single purchase, institutions can calculate what they owe overall. The issuer side and merchant side settle according to network rules and their agreements. After settlement, the merchant may receive a payout through its payment provider or bank. That is the key gap. Approved at the counter is not the same as money landing in the store's account. And the amount the customer paid is not always the amount the merchant receives. Card acceptance usually has costs, and those costs can be deducted before the net deposit reaches the business. People often say interchange, but the business usually experiences the bigger picture as card acceptance fees. The exact cost can depend on the card, country, risk, channel, processor, and merchant agreement. Businesses still accept cards because customers expect them, and easier checkout can mean more completed sales. If the issuer declines the request, the merchant does not receive the same approval path. and the sale may need another payment method. A decline could be caused by insufficient available credit, an inactive card, suspected fraud, network issues, or issuer rules. Online payments can look different on the surface, but they still rely on authorization messages, records, and settlement. Subscription billing uses the same basic ideas, but the merchant initiates future charges according to the customer's agreement. A later dispute or chargeback is a different process, where a cardholder challenges a transaction after it has moved through the system. So before this feels solved, there are 4 traps left: fast approval, changing pending charges, payout timing, and fees. First trap, approval feels like payment because it happens in seconds, but it is only a yes or no check. For the merchant, that yes is a green light to complete the sale. It is not cash in the bank. The fast part is the permission message. The slower part is matching records and moving funds later. After that green light, the merchant still has to capture or submit the sale into the later record and money flow. Second trap, a pending charge can change because the first amount is not always the final posted amount. Tips, fuel holds, and hotel deposits make this obvious. The hold is temporary, the posted amount is the final record. Third trap, one coffee looks tiny, but the same rails handle millions of transactions across stores, banks, and countries. At that scale, the network is not just a wire. It gives participants shared rules, message formats, routing, clearing, and settlement processes. That is why your tap is not a direct wire to the store. It moves through relationships between institutions and service providers. Fourth trap, the store usually gets paid after settlement and payout processing, not when the terminal says approved. The customer sees the gross price. The merchant watches the net deposit after payment fees are taken out. Those fees help pay for authorization, fraud screening, routing, records, settlement, and the convenience customers expect. Whenever you see approved, pending, posted, refunded, or disputed, ask one thing: which stage am I looking at? Here is the simple answer. Authorization asks whether this card, merchant, and amount can get a yes. Clearing turns that yes into records. Both sides can match, post, and reconcile. Settlement moves money between financial institutions, and payout is what eventually reaches the merchant side. So the real answer is simple. Approved means permission. Paid means money reached the merchant side. To the customer, it feels instant because the system hides the messy part at the point of sale. For the business, each tap still depends on infrastructure, contracts, fees, risk checks, and payout schedules. That is why your card app, your receipt, and the merchant deposit can all describe different moments of the same purchase. And that is the kind of hidden business system this channel explains. Everyday actions and the machinery behind them. Watch another hidden business system next.